Okay, in Chapter 2, we are going to get into analyzing business transactions, which you're going to find out are events that basically are going to affect the financial statements. So in this chapter, we're going to get into the accounting equation eventually. We're going to talk about some definitions. What is an asset? What is a liability? What is equity? And by the end of the PowerPoint presentation in Chapter 2, we're going to show you the relationship among the three basic financial statements. Okay, so you're going to find as we go through some of these examples on this PowerPoint, it's going to be based on the concept of this person named Carolyn Wells, who is a CPA. This is all about a sole proprietor. Okay, so again, Carolyn Wells, it's a sole proprietor type of company. That's going to matter a little bit later on, but just kind of giving you an idea of what type of business we are talking about when we get into how to analyze the transactions and how they affect the Wells consulting financial statements eventually. So you're going to see, there are some steps you need to go through to identify what are business transactions. And I'll just say off the record that, a business transaction is going to be some sort of transaction. Notice it says describe the financial event. It's anything that's going to affect the financial statements at some point in time. Now, obviously, they talk about identifying property, who owns property, and so forth. That'll take care of itself when we look at some of the types of transactions. But just kind of keep a heads up for, think about, is it an event? Is it going to have some sort of outcome or effect on the financial statements? And then, of course, very important is this thing, the equation, which we'll show you very shortly, is that, the equation, we're going to call it later on, it's going to be called the accounting equation, always has to be in balance. You're going to find that as well. That's got to be true. Okay, so the first type of transaction they're going to show you here is that Carolyn Wells withdrew $100,000 from personal savings and deposited it into a new checking account in the name of Wells Consulting. So basically, this is the money that this particular person is infusing into the company, and basically that's going to be the startup money. This $100,000 is now going to basically belong to the business, not the actual owner. So there's going to be basically an event here that's going to affect the new company called Wells Consulting. So as you can see, what's going to happen is cash is going to be increased into the business. And notice that's going to be the ownership part. That's going to be eventually, we're going to call that an asset. And then notice on the other side, you've got what's called the financial interest, which is the capital part of it. Notice $100,000 goes in as cash, and the other $100,000 goes in as capital. Okay, another transaction. The company buys equipment for $5,000 cash. So as you can see in terms of the analysis, is they're using cash to buy some equipment. And so notice on the asset side of the equation, notice you're simply going to, number one, reduce cash by $5,000 and increase equipment by $5,000. And notice you still have that $100,000 balance that we had at the beginning. We simply just took some of our cash and converted it into equipment, and you have to show that by showing a decrease to cash and an increase to equipment. And if you balance it all out, if you add up your cash, you've got $95,000 there. Equipment is $5,000, and of course, look at the financial interest, which is the equity part of it, is still at $100,000, so there's no change there. And of course, you're still in balance. Here is another type of transaction. Notice the company bought $6,000 of equipment on account. That basically means it's credit. They haven't actually paid cash for it yet. So when you go to look at how the equation is going to work out, since we didn't pay any cash yet, so cash is not affected, you increased equipment, so that's going to have an effect. And also your liabilities, which we're going to call accounts payable, is going to have an effect because you're actually going to be increasing your debt. So the way that would work here is you're going to do a plus to the equipment, which is right here. There's your plus 6,000. And of course, you have to be in balance. So since cash isn't affected, something over on the right side has to be affected. And of course, credit is debt. So notice you show an increase of 6,000 there. And that would be your balance. You got a plus 6,000 here and a plus 6,000 there. If you add up your columns, you've got 95,000 cash, 11,000 equipment. On the left side, that's 106,000. You've got 6,000 of debt, which is what you owe, plus that $100,000 that you started the company with is still sitting there. So that makes 106,000 on the right side and 106,000 on the left side. And guess what? You are in balance. Okay, another transaction where you bought some supplies, you paid cash, $1,500. So again, look at cash is going to go down by $1,500. Cash is on the property or the asset side. And of course, you have to show an increase to supplies, which is a plus $1,500, goes right there. So there's your minus $1,500 to cash, plus $1,500 to supplies. And when you add up the columns, notice you're still going to have the same $106,000. Notice you've got $93,005 cash. You got your supplies, your equipment, there's your 106,000, and then notice the accounts payable hasn't changed yet, that's still 6. The capital part hasn't changed, that's still 100,000. You add those together and you get 106,000, and guess what? You are still in balance. Okay, so let's say now you're going to pay down some of that debt, and in this one you made a payment of $2,500. So notice cash, you're going to reduce that by $2,500. The debt, the accounts payable, goes down by $2,500. Notice there's a dual effect here. Negative on the left side, negative on the right side. Then you net your balances. Cash is now at 91. Nothing changed on supplies. Equipment still the same. So that took you down to 1035 there if you add these together. On the right side, the debt went down to 3,500. The capital is still 100, and notice you are still in balance. Okay, on this transaction, looks like you made a payment of $8,000 rent in advance, and you're going to find out that that's called prepaid rent. And so notice cash goes down by $8,000, prepaid rent goes up by $8,000, and we'll get into this in some future chapters, but that's actually considered an asset because there's going to be a benefit. You bought something in advance, you now have the benefit of using the facility, whatever you're renting. It's called prepaid rent. So that's why they put that on the left side of the equation. But notice you reduce cash by 8, you increase prepaid by 8. That's basically a wash, but you still have to net everything. Cash went down to 83. Supplies is still the same. There's your prepaid, there's your equipment. Notice you're still at 1035, and nothing changed over here. You're still at 1035. You're still in balance. Okay, so we're going to get into some definitions here. So there's some questions. What are assets? And it says, assets are property owned by a business. So I'll just kind of keep it real simple. Think of an asset as something, again, I'm just going to circle this, something that you own. Okay, think of assets are what you own. Likewise, when you're defining a liability, it says definition, liabilities are debts or obligations of the business. I'll keep it simple. Liabilities are what you owe. Okay, so if assets are what you own, liabilities are what you owe. Okay, now, last question. What is this thing we just talked about called equity? And of course it says, owner's equity is the term used by sole proprietors. It's the financial interest of an owner or business. It's also called proprietorship or net worth. And so I want you to think of in a moment, we're going to get into the actual accounting equation. You're going to find out that equity is going to basically be defined as what's left over as well. So for example, if you take your assets, what you own, and you subtract out your liabilities, which is what you owe, the difference is also going to be called equity. Okay, so the next question might come up is, what is a balance sheet? And we're going to get into that later. But notice it's a formal report of the financial position of a business on a particular date. So I want, the idea here is it is reporting the actual position of a business, and it is a particular date. Notice it says it reports your assets, your liabilities, and equity. And when we put up the accounting equation in a moment, I'm just going to kind of remind you that, simply put, is that the balance sheet is going to be your accounting equation in detail. Okay, so like I had said earlier, your fundamental accounting equation, notice you've got your assets on the left side of the equation. On the right side of the equation, of course, here's your equal sign. You've got your liabilities and you've got your owner's equity. Now, like I said before, I gave you some quick definitions, but let me just give you a note here. So we can say your assets are what you own, your liabilities are what you owe. And I can rewrite this equation. Notice it's just like a math class. So we could actually take the liabilities and move them over to the left side of the equation, and I can rewrite this like this. I could say your assets minus your liabilities also equal your equity. So in the previous PowerPoint slide, when it was giving you the definition of, okay, what is equity, and it talked about your net worth, I like to define equity in terms of the accounting equation. If you look at, it's basically what you own minus what you owe. Your equity is really, they like to call it your residual. I'm going to write that right here, your residual, or basically what is left over. Okay, so you'll hear us talk about revenue pretty much all semester. Revenue is basically how a business earns its money, but it's an inflow of money basically from the result of a business doing its normal operations. Depending on what the business is. If it's a merchandiser like Walmart, they're going to get their revenue from selling merchandise. If it's a law firm, they're going to get their revenue from performing the law service. If it's a CPA, it's from doing your taxes. But it's an inflow of money. On the other side of it, revenues are inflows of money, expenses will be outflows of money, and this is basically, how a business operates. A business typically will incur expenses to make revenue. Okay, so you notice on this slide, this actually is the accounting equation. Look at the top, you've got, I'm going to change the color here, you've got the assets here at the top. Notice here's your equals, then you've got your liabilities and your owner's equity. Okay, notice they list all your particular assets on the left side, and then here's all the balances down here at the bottom. And then of course your liabilities, accounts payable is going to be your most common liability for this class. So get used to that name. Your debt, accounts payable is 3,500. Notice under the equity, you've got this Wells Capital, which is at 100, and it looks like there was $36,000 of revenue. That's also going to be on the equity side. Notice that if you add up all the columns, you do indeed balance. Notice on this particular transaction that the previous slide had a cash revenue. Here's an example of a credit revenue, $11,000. And notice how accounts receivable, which is also considered an asset, is going to increase. Your revenue is going to increase over here. And again, you're still going to be in balance. Here's the dual effect of the accounting equation. Here's an example of collecting from some of your credit customers. It was a $6,000 collection. So you're going to increase cash by 6, decrease accounts receivable by 6, and of course notice how nothing really is affected on either side. In total, you're still in balance. Again, another transaction, this is going to be for an expense. Notice you've got $8,000 in salaries expense. You paid in cash, so you're going to reduce cash by 8. And notice that it's going to increase your expenses by 8. And again, you're still in balance. Here is a utility expense, again paid in cash, 6,000 decreases there. And notice how the expense also increases on the equity side. You're going to find there are going to be sometimes the owner will withdraw money from the business. You reduce the cash, and notice the withdrawal is going to come out of the equity side. There's going to be a reduction in capital of 5,000, and again, you still do balance. Okay, another financial statement we will look at is called the income statement. This is simply a summary of netting your revenues minus your expenses, and you arrive at what's called a net income or net loss. And there's always a date on these financial statements, and typically your income statement is going to be for a month or for a year, as opposed to the balance sheet, which has one exact date. The income statement usually says over a period of time. As you can see in this one, here is an example of an income statement. Notice you've got a date for the month ended. Notice you've got the revenue here. Here's your expenses. You add up your expenses, you subtract those from the 47,000, and you arrive at a net income of 38,350. That's called your net profit. Finally, the other financial statement is called the Statement of Owner's Equity. And if you'd been paying attention and you looked at the accounting equation, you'll notice the different items that affected the equity side of the equation. So basically net income, which is your revenues and expenses, and any withdrawals. And so what you basically do is you have your starting balance, you add net income, you subtract out the withdrawals, and you get this amount, which is called the ending capital balance, 133,350. And then you'll also notice that when you actually look at the balance sheet, this is your accounting equation. Notice you've got assets equals your liabilities plus your stockholders' equity. So if you were to list all of your assets once you've done all your transaction analysis and add them up, look at all your debt, and then look at your equity. When you add those together, notice, look at the balance. 136,850 equals the 136,850. You are in balance. That's again why they call it the balance sheet. And again, look at the date. It's one specific date. It's not for a time period. It's one exact date. Okay, so this is somewhat important. When you start to actually put together the financial statements, there's actually a specific order you have to prepare them. So number one, the income statement actually is going to be the first one you prepare. The statement of equity is going to be the second one, and then the balance sheet is going to be the third one. And you're going to find that basically the way it works is whatever you get on the income statement is going to be added or flowed through to the equity statement, and then you update your equity. And then whatever you get on the equity, that's going to then be presented on the balance sheet. So that's why you do it in this particular order. So you calculate net income first, you then add that into your equity, and then you take the equity and simply plot it on your balance sheet, and then hopefully you balance. Okay, so finally here's a nice little illustration to show you the relationship. So notice at the top you've got your income statement, revenues minus your expenses. Net income was 38,350. And then I'm going to change my color so it stands out a little bit more. So, and then this number, then notice how that gets transferred to the equity statement. All right, so income statement is number one, and then you transfer that to the equity statement. If there's any withdrawals, you subtract it. You come up with an ending balance for equity. This will be your second financial statement. Okay, and then finally notice this number then gets plugged right down into your balance sheet, into your accounting equation, and then in this case, you do balance at 136,850, and I will label this as your number 3 financial statement. Please do it in this order. This is how we always do it.